China's PMI for August fell from 49.3 to 47.8 points, yet another indicator for a global slowdown. Cobie Le Grange, investment analyst at Acsis, joins us in studio to talk about the low growth environment and how this affects investment strategy. One thing we can be sure about is a low growth environment is going to be here for a while, not to stay, but for a couple of years. Would you agree?
Yeah, I mean, and the issue that you've got, Bronwyn, I think is that if you set objectives for your clients 5 years ago or 8 years ago, it becomes quite difficult to now try and understand what you need to be doing you might know what to do from an asset allocation perspective, but what do you do from an objective setting perspective in order to ensure that you kind of make sure that you kind of continue to think about expectations of your investors. And that is becoming a huge thing in the industry at the moment.
Warwick, are you convinced? Well, you were bearish in the earlier discussion, so I'm sure you're pretty much in sync with Cobie on this one.
Yeah, I mean, you know, the biggest problem is that as the last few years have gone by, your list of investable assets has got shorter and shorter. I mean, it wasn't so long ago, for example, that Italian bonds were sort of all right. Now, that's the world's third largest bond category. It's just disappeared off the board. It was only a year and a half ago that defensive stocks on the JSE were very, very cheap, P's of 10 to 12. Not anymore. So it's got trickier. It's got a lot trickier.
Now, and how do you do asset allocation in a situation like that? Because you've got all your asset classes. Some of them, as you quite points out, that some of them have actually fallen off the board. But you've got some asset classes you can invest in, but you can't invest in all of them based upon your expectations of where you think the industry is going to go. I mean, if you just look at the Aussie, investors continue to talk about the fact that it's at an all-time high. Well, that's financials and industrials that are driving that at the moment. You don't have resources driving any of that at the moment. You've got valuation on your resources side, but you don't necessarily have valuation driving all your financials and industrials. Certainly there's cases where there's a valuation argument. But for the broad category, where are you going to be going? So now think about it. You sit as an asset manager today. You're trying to make prudent decisions as far as your portfolio is concerned. Are you going to generate the returns in the short term? Well, it's probably going to be quite difficult.
And we've got to get used to the fact then that we can't be too positive on the equity story. To date, people have made a lot of money on equities if you've played your cards right. Is that correct? Do you think you're going to still get those individual equity plays that are going to shoot the lights out and completely change your portfolio?
Well, I'd like to suggest that in the last 12 months, if you've ignored valuation, and you've just gone with theme-based investing. So you've literally just gone into the stuff that you think, you haven't worried about any valuation. You haven't, you've done no calculations. You probably would have done quite well. If you've done valuation type calculations and you've thought about it prudently and you've tried to allocate money kind of in that kind of fashion, you've done pretty poorly.
All right, so now do your valuation calculations on the retail stocks, the discussion we were having a little earlier. Value investors are saying, stay away, this party can't go on. Growth momentum investors are saying, where the party's not going to stop. Keep your play in the retail and industrial stocks.
The problem that I think you've got, like for instance in retail stocks, is let's play both sides of the game at this stage. Let's assume that the earnings party stops as far as your retail stocks are concerned. The margin by which they have to fall in order just to come back to market averages is so large that you're probably going to wipe away half your wealth. Now an investor has to sit down and say, okay, well, from an objective perspective, am I happy with half my wealth being wiped away? If you're happy with that, and with the bet size that you've taken in your total portfolio, be my guest, carry on investing. But if you're kind of sitting back and you're saying, well, listen here, halving the valuation if the earnings party stops and halving the share price by default, if you're going to be doing that, is potentially not something I want to expose my portfolio to. Maybe it's worthwhile maybe staying away from something like this. And that's the issue with asset allocation. You've got to kind of think about both ends of that. Certainly from my perspective, buying stocks at 24 PEs, that's a big price to pay.
The other end of the spectrum is, of course, the resources that we were discussing earlier. And Philip saying that as a private investor, you've got nothing to lose. By buying these stocks now, you've got a long-term horizon, so you can hold comfortably for 3, 4, 5 years, wait for the turn, and then obviously capitalize on the upward momentum. However, the discussion comes back to the fund managers who cannot afford to underperform and continue to buy into the resource story if they're going to go lower.
Yeah, but that's sad for me, because at the end of the day,
well, you are the fund managers. You're under this pressure.
Are you doing what is prudent for your client at the end of the day? And again, this has got a lot to do with actually setting expectations with your client at the end of the day. So, and again, this comes comes back to financial planning. Financial planners should be sitting with clients today and saying to them, listen, it's a tough environment. We're going to have to make some hard decisions, but based upon the hard decisions, long term, this will pan out the best way for you. So try not to look at the short-term numbers. Rather, pack it away and don't look at it. But can the industry do that? Very difficult.
You can't, because you've got the external pressure. So how does a fund manager navigate through that external pressure and suffer the poor performance that could, Cobie, let's be honest, potentially lose him his job or her job?
Well, I'm going to think about asset management in two different camps. You get the one camp which we call relative based performance, and the guys that kind of think about it from a benchmark cognizant perspective. So they're going to start off by saying, we've got the AUSI, we've got the shareholder weighted index, and now we're going to buy assets relative to that. So that's the one, and in that case, guys would say underweight this and overweight that, and at least they're going to try and do better than the benchmark. The guys that will end up probably worse in the short term are the guys that aren't benchmark cognizant. The people that say, look, sell that and buy this, leave it alone, we'll make money long term out of this. And more importantly, I think, understand from a client perspective who you invested with and exactly how they actually understand benchmarks and being either benchmark cognizant or not benchmark cognizant.
Or can you afford to ignore the external pressure?
I can, because I've got private clients who don't interact in the same way. But it's, I mean, you know, if I was to invest for 1 month, yes, I probably would buy retailers, but, you know, invest for 5 years resources. So, you know, you've got a dichotomy there. You know, do you run with the herd, or do you actually do something different? And that, I think, also highlights why Warren Buffett is so successful as an investor, because he doesn't have these pressures on him. Yet, I mean, he's one of the largest insurers in the world, which also happens to be one of the, well, I mean, insurers are customers of asset managers, and yet they're setting their performance benchmarks wrong, I'm sure. I mean, it's an industry that actually needs to perhaps reinvent itself on this problem.
Yeah, I mean, I'd like to say that, I mean, the best fund managers, if you want to be completely fair as a fund manager, you need to be in an unlisted space where you're managing segregated base portfolios for your clients, and you're potentially then in a situation whereby you could sit back out of the noise, and this is AKA Warren Buffett. This is what he does. He sits outside of the noise and says, I'm going to do what's prudent, and that'll pan out long term, rather than trying to do what's popular. And let's try and set objectives relative to those kind of parameters. And he's thinking with a business mind on a continuous basis. He's thinking, what kind of businesses and assets do I want to own? That's classic 101 investing, right there.
Coming back to different asset classes, listed property, how do you feel about it right now? Philip Bradford again, Absa Wealth, is saying this for them is a good bet going forward. Do you agree, especially in this low yield argument?
Sure, big numbers. Big numbers. We're talking about return numbers out of listed property, and just on an ongoing basis. As a matter of fact, 2008, I thought by myself, well, with the business cycle ending to the degree it does, this will spill over into the listed property space. Never did, and continues to just kind of compound and compound and compound. I want to say two things. If you think about it logically, I think that the beneficiaries of a booming business cycle is the property space. If you don't have a booming business cycle, you don't have a property space that can make money out of that. So then you have to kind of then start thinking about yield compression. You have to start thinking about income that starts compressing and compressing on the downside. That potentially means less earnings, which means less dividend flow, etc., etc., etc. That surely has to be on the horizon for listed property businesses. Surely that is something that one has to take into consideration. So, and as a matter of fact, I mean, the work that we've done with listed property businesses would indicate that, you know, that there's a lower growth environment for them ahead as well. It can't just carry on kind of being in this booming situation. And the other thing, this is the second factor which kind of concerns me about the sector, is the fact that you've got a whole range of new listings coming into that space. Surely that says something about it.
Warwick, let's get your opinion there.
Yeah, I would agree with that. I mean, nobody sells something that's necessarily a hell of a cheap, you know. So yes, new listings is a little bit of a flag. And then, as I've said before, you know, it depends on who you invest in as well. For an institutional investor, there's no question property makes sense. For a marginal taxpayer, paying 40% on top of those yields, property doesn't make an awful lot of sense.
You said earlier you're dealing with private clients. Are they calm at the moment? Are you getting frenetic calls, or is everybody backing off? They're
a mix, to be honest. I mean, look, there's a lot of big news coming in the next month. September is it's going to be huge. I mean, we've got the ECB assessing Greece, we've got Jackson Hole, we've got a regular ECB meeting, we've got the German Constitutional Court decision, we've got the Dutch
all
elections.
This noise, surely, as a value investor?
I try.
It's still going to buffer your investment decisions, is it?
I mean, you know, if you sat back 5 years ago, or let's say 3 years ago, and you sat with an investor and you said, listen, you need to think about being invested for 5 years, hypothetically, in a big, mixed, diversified type portfolio type situation where they don't just own equities. You probably now have to be sitting with a client like that and saying, we've seen the reversion happening out of 2008. That's been good. But we're sitting from the one crisis, the subprime crisis, right into the next crisis, which is now the sovereign crisis. So you're seeing markets just flatlining. There is upside, but it's very selective. And on the back end of that, you've got to start thinking beyond the normal terms of holding it. Extend by 2-3 years. Things could look very good, but they could just look the same way as what they look at the moment. And you've got to kind of be cognizant of that as an investor.
Just in terms of your top pick to private investors out there, right? Well, not top pick, but the best strategy to deploy amongst all the noise and the low yield environment, what would that advice be?
Well, I think firstly, as would anybody that has, you know, that have got private clients, the first thing is set an objective. Understand what you're trying to achieve and how you're trying to achieve that. Make sure that it's related in real terms to a growth number. Once you've set those, make the most prudent valuation-based decisions that you possibly can in various asset classes, and then build yourself a portfolio that you're prepared to stick with over the long term. Don't trade, invest. Make sure that you do that over the long term.
And you know the question coming to you, you're not going to escape it, Warwick. You're going to close out on your investment advice to private investors out there.
My attitude remains, go for assets that are shot to pieces and otherwise stand to the side.
Valuation. Good advice.